I haven't figured out yet whether this is going to go into the miscellaneous category or under the selling option contracts. This is a little bit of a spontaneous thing. I think I want to talk about income versus capital gain. People really get it confused. Capital gain is an intrinsic, based on the intrinsic value of whatever it is you're buying and selling. Sometimes it's referred to as the greater fool theory. Hopefully, though, it's not that. I think the main point I want to make here is basically the buy and hold strategy is just, for most mere mortals, that's just whistling through the graveyard. Now, somebody like Warren Buffett, big players, they get a lot of perks for owning that stock that you and I don't get. For example, Warren Buffett's holding company has a board seat in most of those companies they have holdings in: Coca-Cola, railroads, insurance companies, and a few they own outright. They own all 100% of it, so they can dictate what they get. You and I, we own 10,000 shares of a publicly traded corporation. That's nothing. We hold no sway whatsoever in what comes to us. So there's only two ways we get any money out of those deals is through dividends. That's extrinsic value. That's income. Or intrinsic gains when the stock goes up. The problem is when the stock goes up, you've got to sell it to take your profits. And most people just hang on it and hang on to it. You know, it's going to go up, up, and up. It's not going to go up forever. You know, it's like this, up and down. So if you don't take your profits off the table, you're going nowhere. So at any rate, I'm not an investor in the common sense of the word. To be honest with you, I think common stock is probably the greatest ripoff in the world. Because number one, unless you bought in on the initial public offering, none of the money you paid for the stock is going to the company. It's going to the last person to own the stock. So you're basically just, you know, it's sort of a shell game. Now, if you're good at market timing, and I've seen people who are extraordinarily good, then there's a lot of money to be made. Same could be said playing poker. But you really have to stay on top of that, and you need to take your profits off the table. And the best way to do that is to determine, in other words, when you place an order for a stock and you get it, let's say you get it for $10, you should immediately put in a sell order for limit order for $11. That would give you a 10% return on your money. So if in the trading it peaks up to that and your order is executed, you've made yourself 10% on your money. But I would never buy a stock that I didn't already have my profit goal defined and orders in place to take advantage of it. Now, generally in making a market or selling covered stock option contracts, I want to buy a put or sell a put, and get that premium. Because let's say it's a $10 strike price, and I get a 30-cent premium. Well, if that's executed at $10, I've actually paid $9.70 because I received a 30-cent dividend. So I get the stock at $10, and if I'm lucky, I can turn around and immediately sell a call contract with the same strike, $10. It may be for less premium. Let's say it's 10-cent premium. Remember, we're only talking week-long contracts here, so you're not tying up your money for a very long time. So if I do that and it gets called away, I get all my original investment back, plus the 30 cents and the 10 cents. I got 40 cents. Damn, that's a mighty good return on investment for 5 days risk. So the objective in all my videos on this subject are to show you what I do and have been doing since 2005. And on my website, I have 2 years of trading documented. So you can actually see how I did over a period of 2 years. So I guess I'm going to leave it at that. So it didn't turn out to be miscellaneous after all. So I'll put this in the playlist for stock options. And but this whole thing about the difference between intrinsic and extrinsic values, that's very important. I'm in it for the income. Anyway, I got to squeeze that dollar to get income out of it. That's what I'm going to do. And the nice thing about selling stock options, you typically don't have to time the market. It's just a question of how much you make, how little you make, but you make something. There's been some exceptional exceptions to that I've experienced. My biggest loss was following chasing the energy sector, petroleum, back when it burst, and I took a $170,000 paper loss. Now, in fact, I took in $150,000 in premiums. So I had a taxable loss, on a capital gains loss of $170,000, and actually only lost 30. And that was just one sector of my investments. Back then, I was doing really, really heavy stuff. I could have $250,000 in play in a week. Don't do that anymore for personal reasons. My wife, for 49 years, developed Alzheimer's, and so for 6 or so years, it was rough. And in those situations, there's no such thing as having enough money. So anyway, I'm not doing that. I don't have $250,000 in play anymore. And even in that, the company that I lost so much money on, I bought in at 21 and got out at 7. Because I was afraid the way things were going down, that company might not exist. Plus, there was a lot of rumors about either a buyout or a bankruptcy or whatever, and I didn't want to take any more losses on it. If I had stuck with it, it was 2 more years before that company actually bit the dust, and I would have made enough premiums that I'd have no actual loss whatsoever, and still all the capital losses. In terms of the way there's a thing called that I call the IRS 30-day rule, and it has to do with when does one trade, one event wash out the other. And basically what it means is that you're, if you replace a stock within 30 days of having sold it, any gain or loss, capital gain or loss, would be washed out. So typically, since I do 1 week contracts, unless I have a lot of puts not exercised, I rarely go over the 30-day to the 30-day window to capture that gain or loss. Since I have such a big capital loss carry forward, I don't worry about it anymore. But if I didn't have that, I would have to look at in December and see if I needed to switch from the company I'm currently using to base my stock options on, which right now is Haynes Brands, and switch to another stock for 30 days. Continue to sell options, but it'd be just on a different stock. The one I've had a lot of success with, although I'm skeptical of it right now, is American Eagle Outfitters. The reason I'm skeptical about it right now is it's basically mall-based, and the mall traffic is really down. I don't know that their online business has done very well. So, but they got a top-notch retail management, but they happen to be positioned poorly, I think, as do a lot of department stores and retailers in general. It's going to take time for those leases to run out so they can get out from under that and do something more profitable. Okay, I'm rambling now. I guess that will do for there's actually quite a bit of information there for you to absorb. But this whole concept of intrinsic versus extrinsic, you really need to have that nailed, because as you do your trading, you're going to see your current market value, that is your liquidation value of your account, go up and down like you would in a 401k. But the revenue is coming in all the time. Now, the only timing I do is when I want to take out a large amount, like I took out 10,000 out of my account a little over a year ago, is try to do that when the market is down. Now, that's opposite of somebody who's actually has the stock. But remember, I'm essentially selling short. But because I can take out the money then and still have a lot of cash, but the stock is cheaper, so I can still sell a lot of contracts. And the way you determine success doing what I do is seeing the revenue stream grow and the number of contracts you can cover grow. As far as taking money out, I would try to limit that to no more than 20%. So lately I've been bringing in about $150 a day. So I wouldn't want to take out more than $25 a day. Doesn't sound like much, but that's 10 to 250. That's what, $1,000 a month. If I did my math right. Anyway, and if I didn't, I'll put it in a comment thing. So it's a good way of, you're taking your profits every week. You're taking your profits every week. You're taking them off the table every week. So you can either put them in your pocket or let it ride and build your revenue stream. But that's something you have totally under your control. All right, I think I'll wrap it up with that. And please subscribe, notify, and if you like what you're seeing, please hit like. Thank you.